Hi there, accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 10, which deals with current liabilities, Chapter 11, which deals with bonds payable, another form of liability that a corporation is responsible for, and lastly, Chapter 12, which deals with stock. So in this question, it asks us, the entry made by Guarantee Company on January 1st to journalize the proceeds and issuance of the note is. Taylor Bank lends Guarantee Company $150,000 on January 1st. Guarantee Company signs a $150,000, 8% 9-month interest-bearing note. So the key thing is that we know this problem is asking us to record the journal entry when the $150,000 was received. It's not asking us anything about interest at all. So based on that alone, we can rule out with the process of elimination. We can rule out A, we can rule out B, and we can rule out C. But the key thing with accounting is that we need to ensure that the transaction, as it is being recorded, it follows the fundamental principles of accounting. So in this case, we received cash, and we know that cash is an asset account. And anytime there is an increase to any form of an asset account, it could be cash, it could be equipment, it could be accounts receivable. There's only two sides of an account. There's the left side and there's the right side. The left side is the debit and the right side is the credit. And as we are dealing with our asset types account, they are only increased on the left side, which is a debit. So if we look at this entry, or even if we looked at A, we know that A would be incorrect because we see that cash is being credited. So Guarantee Company is not paying $150,000 in cash, so we can rule that out. And then we look to B. So B, okay, we see that there's $138,000 debited for cash, and for C, there's $162,000, but D most accurately reflects what happened. We received $150,000 in cash. Why? Did the company earn the money? No, it says nothing about us providing a service or selling a product. Did the owners invest the money? No, it tells us nothing about equity. But in this case, we borrowed the money. So this notes payable represents the liability. And with all liability accounts, those are increased with a credit. So our correct answer is D, debit cash and credit notes payable. So in this question, it asks us, what is the gross pay for Martin? Thomas Martin receives an hourly wage of $40 with time and a half for all hours worked in excess of 40 hours during a week. Payroll data for the current week are as follows. The hours worked are 48. The federal income tax withheld is $350. Social Security tax rate is 6%. Medicare tax is 1.5%. What is the gross pay for Martin? So the key thing for us to keep in mind with this problem is that it is asking us for the gross pay. So we have this Excel spreadsheet that we are going to refer to. All right, so as mentioned, the key thing is that this problem is asking us about gross pay. So our gross pay is our regular earnings plus our overtime earnings, and that gives us the gross pay, the total amount that we've earned. So in this case, we know that he receives $40 an hour, so it'll be $40 an hour times the 40 hours for a total of 1,600, and it lets us know that he worked 48 hours. So therefore, 8 hours were in excess. So in order for us to determine the the overtime hourly rate, got a little tongue tied there. All right, so the overtime hourly rate, this is like a tongue twister. All right, it's 1.5 times the regular rate. So 40 times 1.5, that gives us $60 an hour, right? And again, we could also look at this way. What's 1/2 of $40? 20. 40 plus 20 equals 60. So in order for us to determine our overtime earnings, it would be the overtime hours 8 times our overtime hourly rate as calculated below 60, 480. So therefore, our gross pay is 1,600, which is 40 hours multiplied by our regularly hourly rate of $40, plus our overtime hours of 8 hours, because the problem says that he worked 48 hours. So 8 hours multiplied by our overtime hourly rate, which is 1.5 times the $40. So therefore, the total gross pay in the scenario is $2,080. So now this next problem asks, what is the net amount to be paid to Jackson? Martin Jackson receives an hourly wage rate of $30 with time and a half for all hours worked in excess of 40 hours during a week. Payroll data for the current week are as follows: hours worked, 46, federal income tax withheld, $350. The Social Security tax rate is 6.0. Medicare tax rate is 1.5. What is the net amount to be paid to Jackson? So we already know how to calculate our gross pay. We calculated it previously. So 40 hours multiplied by the regular hourly rate. And in this case, it says he receives an hourly wage rate of $30. So that's 1,200. Our overtime hours is our overtime hours multiplied by overtime hourly rate. So in order for us to determine our overtime hourly rate, it's $30 multiplied by 1.5. So therefore, the overtime hourly rate is 45. So he worked 46 hours for the week. The overtime hours is 6 times 45. So the total gross pay is the $1,200 for regular earnings plus the overtime earnings for a total of $1,470. Keep in mind, this problem is asking us for net pay. So in order to determine net pay, it is the gross pay less all of the deductions. So in this case, we have to factor in the Social Security tax, which is the gross wages multiplied by 6%. So 1,470 multiplied by 6%. There's Social Security tax of $88.20. Medicare tax, which is 1.5%. So we multiply the gross wages by 1.5%. And then our federal income taxes, this $350, that amount was already given. So in order to determine our net pay, it is the gross pay minus our deductions, which is our Social Security tax, gross wages multiplied by 6%, minus our Medicare tax, gross wages multiplied by 1.5%, minus the federal income taxes withheld, and that amount is given in the problem. So based on that, the net pay is $1,009.75. All right, so this problem asks us to journalize the entry for payroll. If an amount box does not require an entry, leave it blank. It states the payroll register of Seaside Architecture Company indicates $970 of Social Security taxes and $257 of Medicare taxes withheld on total salaries of $16,500 for the period. Federal withholding for the period totaled $4,235. So it lets us know that the total gross pay for this period, which is in the form of our salaries expense, is $16,500. But again, as we just saw in the previous problem, we have gross pay, but then we also have to account for deductions for Social Security, Medicare, and federal income taxes withheld. And then the difference between the two is what is paid to employees. So we accounted for our gross pay to $16,500. Now we need to account for the deductions. So we have Social Security tax payable, which it lets us know is $970. Medicare tax payable, which the problem lets us know is $257. And then our employees' federal income tax payable, which the problem lets us know, is $4,235. So this represents the gross pay, Social Security tax payable, Medicare tax payable, and employees' federal income tax payable represents the deductions. So therefore, the difference between the two is our net pay to employees. So 16,500 minus 970 minus 257 minus $4,235. So 11,038 represents our salaries payable, the amount that we are going to pay our employees. So in this example, it asks us A, to journalize the entry for the vacation pay, and for B, journalize the entry for the pension benefit. Martin Services Company provides its employees vacation benefits and a defined contribution plan. Employees earned vacation pay of $39,500. The pension plan requires a contribution to the plan administrator equal to 9% of employee salaries. Salaries were $750,000 during the period. So for this information here, it's asking us to journalize the entry for the vacation pay. So we would debit our vacation pay expense for the $39,500. And in this case, the employees, they earned this vacation pay, but we have not paid it as yet. So therefore, we would credit our vacation pay payable for that amount. And then when our employees actually take their vacation, from there, we would decrease the liability. So now for part B, it says to journalize the entry for the pension benefit. So the pension plan requires a contribution to the plan administrator equal to 9% of the employee's salaries. Salaries for the period was $750,000. So therefore, we multiply the salaries by the percentage, which is 9%. So therefore, $67,500 needs to be contributed. We debit our pension expense for $67,500. And in this case, we would credit cash. Why? Because we are paying this $67,500 to fund the pension plan. So this problem is fairly simple. The key thing, again, is just understanding the logic of what is happening. The vacation pay, the employees worked for us, so we incurred the vacation pay expense. We set it up as a liability because the employees have not yet taken the vacation, but when they do, they're going to receive the vacation pay. And for B, we are contributing to a pension plan on behalf of our employees. 9% of the employee salaries, and salaries for the period was $750,000. So $750,000 multiplied by 9%. For a total of $67,500, and we credit cash because we are paying the amount now. This brings us to Chapter 11. It states, if the issuing corporation uses the straight line method to amortize a discount on bonds payable, the semi-annual amortization amount is on January 1st, 2 million 5-year 10% bonds were issued for $1,960,000. So we see that these bonds were issued at a discount. How do we know? The value of the item is $2 million, but it was sold for $1,960,000. Interest is paid semi-annually, so that means twice a year, which we see here is January 1st and July 1st. If the issuing corporation uses the straight line method to amortize a discount on bonds payable, the semi-annual amortization amount is all right. So in order to determine the amount, there's some calculations that we need to be aware of. So the semi-annual discount calculation is as follows. It is the face value minus the issue price divided by the number of semi-annual periods. And the number of semi-annual periods is calculated as the number of years multiplied by the payments per year. And in this case, it is 2 payments per year. So we do the calculations. So the face value is 2 million minus the issue price, which is 1,960,000. All right, so if we subtract the 2 million minus the 1,960,000, the next step is for us to divide it by the number of semi-annual periods. So the number of years is 5 years, and the payments per year is 2. So therefore, 5 times 2, it should be, so 5 times 2 is 10. So therefore, the total amount of our semi-annual discount calculation is as follows: 40,000, which represents the face value of 2 million minus the issue price of $1,960,000. The difference between the two is 40,000, and that represents the discount, divided by the number of semi-annual periods. And the number of semi-annual periods is the number of years, which is 5, multiplied by the payments per year, which is 2, because it is semi-annual. 5 times 2 is 10. So 40,000 divided by 10. Therefore, the semi-annual amortization amount is $4,000. Now for our next problem, it's asking the amount of bond interest expense to be recognized on July 1st is Franklin Corporation issues $50,000 10% 5-year bonds on January 1st for $52,100. Interest is paid semi-annually twice a year on January 1st and July 1st. If Franklin uses the straight line method of amortization of bond premium, the amount of bond interest expense to be recognized on July 1st is. So in this case, we're dealing with a bond issued at a premium. How do we know? The face value of the bond, which is $50,000, is less than the issue price. All right. And just a quick little tip, quick little learning lesson for those of you who might not remember the greater than, less than, which one is which. As we see here, we see the sign. One tip is that the less than sign looks like a slanted L. So if we see here, it looks like, a slanted L. So this lets us know that what it is saying is that the number that is before it is less than the number that comes after it. And that proves true in this case because the face value is 50,000 and the issue price is 52,100. So in this case, we're dealing with a bond that's issued at a premium. The bond interest expense is calculated based on the face value of the bond and the stated interest rate. And the amortization of the premium, it reduces the carrying value of the bond towards its face value over time. So at the end of the 5-year period, the carrying value of the bond is going to be equal to the face value. But to solve this problem, we would approach it as follows. So we need to first determine what is the bond interest expense? How much do we promise to pay them? So we calculated as follows: the face value, which is $50,000, multiplied by the interest, which is 10%. So I'll put 0.1 multiplied by 2. All right, so we calculated as follows. $50,000 times 10%. Oh, this actually needs to be 1/2. needs to be times 1/2. Sorry about that. So times 1/2. All right, let's just times 0.5. All right, and the reason why we are using 0.5 is because it's being paid twice a year. So let's start from the top. So 50,000 multiplied by 10% means that $5,000 in interest is going to be paid each year. But based on the problem, interest is paid semi-annually, which means that payment is going to be made twice a year. So therefore, $50,000. Now I think what we can do divided by 2 or divided by 1/2 of a year. So we'll switch this up. All right. We're going to switch this up around because I don't want you to get confused. Divided by 2. All right. So again, how did we get this amount? We got this amount because we divided the face value multiplied by the interest. So 50,000 multiplied by 10%. And that essentially gives us the total interest that is going to be paid for the entire year. But again, payments are being made twice a year. So therefore, the amount that is going to be paid each year, or every 6 months rather, is 5,000 divided by 2. 2,500 is going to be paid every 6 months for a total of $5,000 per year. So we'll put this in yellow because we're going to use this again. Next, we have the amortization per period. So in order for us to determine the amortization per period, it is the bond realization minus the face value divided by the number of semi-annual payments. So the bond realization, which is the carrying value of the bond, 52,100, minus the face value of 50,000. So if you subtract the 2, 52,100 minus 50,000. And then the next step is asking us to divide it by the number of semi-annual payments. So the number of semi-annual payments, as we know, that is essentially multiplying the number of years by the number of payments. So the number of years is 5. The number of payments is 2 because we're paying it semi-annually, twice a year. So our calculation is as follows. 2,100 divided by 10 will be 210. So then now the next and final step, we're going to put this in yellow because we're going to use this number. So to find the net interest expense, we subtract the amortization discount from the total interest. So our total semi-annual interest, I'm going to make this a little bigger. Our total semi-annual interest is 2,500 as we calculated below, less the amortization discount, which we calculated as 210. Our net interest expense is $2,290. All right. So again, I'll go over this quickly. The bond interest expense is essentially the face value of 50,000 multiplied by the interest rate of 10%. This lets us know that we are going to be paying $5,000 in interest annually. But Payments will be made twice a year, so that is why we divided by 2. So 5,000 divided by 2 gave us 2,500, and that represents our total semi-annual interest. The next step was to determine the amortization per period. It was the bond realization, aka the carrying value, which is the 52,100, minus the face value, which is the $50,000. And we divide it by the number of semi-annual payments, which is the number of years multiplied by the number of payments. So we subtract 50,000 rather from 52,100. That gives us a difference of 2,100. We divide it by 10, which is the 5 years multiplied by the 2 payments per year. That gave us amortization per period of $210. So we subtracted the amortization discount of $210 from the semi-annual interest, and this $2,290 represents the bond interest expense. All right, we move on to our next question. And this question is asking us to prepare the journal entry. So here we see, on the first day of the fiscal year, a company issues a $1 million 7% 5-year bond that pays semi-annual interest of $35,000. And they received cash of $884,171. Journalize the entry for the issuance. So the company received cash that's less than the face value of the bond. The bonds are worth $1 million. We only received cash of $884,171, which lets us know that this bond was issued at a discount. The discount is recorded as a liability account, but what's called a contra liability account, and the bonds payable account reflects the face value of the bond. So our journal entry would be as follows. We would debit cash, because the problem lets us know we received $884,171. And we would, use the information that we do know. So our bonds payable, even though we only received $884,171 at the end of this 5-year period, we are going to be paying $1 million to the bondholders. And we know one thing about accounting: the journal entries must always be in balance. Total debits must equal total credit. So we see there's a difference on the debit side. So we subtract our total credit from the debit. The difference of $115,829 represents our discount on bonds payable. So this would be our journal entry. Debit cash for the cash received, $884,171. We credit bonds payable for the face value of the bond, and the difference between the two represents the discount on bonds payable. So cash, discount on bonds payable, and our bonds payable. All right, so again, this would essentially be the journal entry that you would input into the program. All right, so for this example, it is asking us to journalize the entry for the first interest payment and the amortization of the related bond discount using the straight line method. So it says, on the first day of the fiscal year, a company issues an $800,000 6% 5-year bond that pays semi-annual interest of $24,000, receiving cash of $690,960. Journalize the entry for the first interest payment. So interest expense, as we know, is calculated based on the face value of the bond and the coupon rate, aka the stated interest rate, which it lets us know here is 6%. Amortization of the discount is calculated using the straight line method. And the net interest expense is the difference between the total interest expense and the discount amortization. So we worked on a similar problem before. So in this case, the bond interest expense, which is the 800,000, and we're going to switch this around so you don't get confused again. divided by 2. Because it should be half of a year, 1/2, but program won't let you input that. So divided by 2. And actually put this below to make it easier. All right, perfect. So this should make it a little easier for us. Okay, so the face value, which in this case is $800,000, times the interest, which is 6%, as the problem lets us know. So therefore, total interest for the year is 800,000 multiplied by 6%. That gives us a total of $48,000 in interest for the year. But again, payments are being made twice a year. So therefore, we divide the total interest per year, which is 48,000, by 2, and that gives us our semi-annual interest expense, $24,000. The problem already calculated it, but just to ensure that you understand how the amount was calculated, that is why we did the calculation here. So this 24,000 is going to be used. Next, we factor in the amortization period, which is the bond realization. All right. Well, here's one thing we know. So we'll scale back up with this problem. And one thing we know for sure is that we're paying cash. So we know based on the calculation that we just did, $24,000 in cash is going to be paid. So we credit the cash for $24,000. And now the next thing that we need to figure out is, all right, what is the discount? So in this case, it would be the face value because we are dealing with a discount. So face value minus the carrying value of the bond. And in this case, the carrying value of the bond is the amount paid, the 690,000. So the face value of $800,000 minus the carrying value, 690,960. So that gives us a discount of $109,040. So it's similar to how we accounted for it in the previous problem where we were dealing with the premium. The difference in this case is that we are dealing with a discount. The same rule applies. So the face value of 800,000 minus the carrying value of the bond, which is 690,960. The discount is 109,000. We divide it by the number of semi-annual payments. It is a 5-year bond. Payments are made twice a year. So 5 times 2 equals 10. So we divide the 109,040 by 10 periods. So therefore, this 10,904 represents the amortization for each semi-annual payment. So we credit our discount on bonds payable for the 10,904. And the reason being is because when we initially set up, sorry, it's going to be a credit, 10,904. When we initially set up the journal entry when we received these bonds, this was the journal entry that we would have recorded. We would have recorded cash for 690,960. We would have credited our bonds payable for the 800,000. And then we would have debited the discount on bonds payable. This would have been our original journal entry, right? When we first issued the bonds. Now for this problem, it is asking us to record our first interest expense payment. So with this interest expense payment, we know that we're going to have some interest expense. As we calculated, we know that we're going to be paying cash of the $24,000. And since this discount on bonds payable was originally set up with a debit, in order to get the balance down to decrease it, we would need to credit it every time we make a payment. So therefore, we would credit our discount on bonds payable. And we know that we are using a straight line method. So as we just calculated the face value of 800,000 minus the carrying value of 690,960 divided by 10. This $10,904 represents the decrease to the discount on bonds payable, the amortization over the 10 periods, the 5 years and 2 payments, 5 times 2. So in order to determine our interest expense, we add the cash paid plus the amortization of the discount. So therefore, the interest expense is $34,904. So this represents our journal entry to record. We debit the interest expense for the total amount, $34,904. All right. So this brings us to our next problem. This question asks, what is the number of shares outstanding? It says the charter of a corporation provides for the issuance of 100,000 shares of common stock. Assume that 40,000 shares were originally issued and 10,000 were subsequently reacquired. What is the number of shares outstanding? So to determine the number of shares outstanding, it is the shares originally issued, in this case, which is 40,000, minus the shares that have been reacquired. And in this case, it tells us 10,000 were reacquired. So therefore, 40,000 shares originally issued minus 10,000 shares reacquired. The number of shares outstanding is 30,000. All right, the next problem asks us to journalize the stock issuance would include a credit to common stock for Nebraska Inc. issues 3,000 shares of common stock for 45,000. The stock has a stated value of $10 per share. The entry to journalize the stock issuance would include a credit to common stock for, so 3,000 shares were issued. The stated value per share is $10 per share. So therefore, the common stock value is 3,000 multiplied by 10, 30,000. So our journal entry would look like this. We would debit cash. The problem lets us know that we received cash of 45,000. So there's an increase to our cash, but we see, all right, but we see that we received, or the value rather of the shares is only 30,000. So our journal entry would be as follows. Common stock would be credited for the value of the stock, which we just calculated, which is 30,000. And then the last part of our entry would essentially be accounting for the difference. So we have what's called an additional paid in capital account. So we would credit our additional paid in capital account for the difference between the two. So additional paid in capital in excess of par. For the difference between the two, which in this case is 45,000, which represents the cash that we received, minus the common stock value of 30,000 because they issued 3,000 shares at a stated value of 10,000. So the additional paid in capital is 15,000. So that's how we will record this journal entry. And this is going to help us with some of the previous problems that we will see. So the correct answer is 30,000. The shares issued, 3,000 multiplied by the stated value of $10. In this problem, it asks us, if Dakota Company issues, bigger, we'll come back to the Excel in a few. if the Dakota company issues 1,500 shares of $6 par common stock for 75,000, actually we can use that Excel to walk through this because it is fairly similar. We'll copy this. All right, so similar problem. But in this case, the shares that were issued were 1,500 shares, and it lets us know that the stated value is $6 per share. So therefore, the common stock value is the shares issued 1,500 multiplied by the stated value of $6. The common stock value is $9,000. So we know that the credit to our common stock is going to be $9,000. And now the problem says that they, issued the stock and they received $75,000. So we would debit our cash account. We received $75,000. But we see that in such case, there's a difference between cash and there's a difference between the common stock of $9,000. All right, because the $9,000 represents the common stock that was received. So therefore, the additional paid in capital in excess of par would be $66,000, which represents the cash received less the common stock value. So based on this, we'll look at the answer choices. The paid in capital in excess of par will be credited for $66,000. This appears to be correct, but let's look at the other choices. Paid in capital in excess of par will be credited for $9,000. Incorrect. Common stock would be credited for $9,000. Cash would be debited for $66,000. Incorrect. The problem lets us know that they received cash of $75,000. D, common stock will be credited for $75,000. Incorrect. Common stock would be credited for the common stock value, which is the shares issued multiplied by the stated rate. So A would be our correct answer. This brings us to this next problem. The entry to journalize the purchase of the Treasury shares on February 1st would include. On January 1st, Vermont Corporation had 40,000 shares of $10 par common stock issued and outstanding. All 40,000 shares had been issued in a prior period at $20 per share. On February 1st, Vermont purchased 3,750 shares of Treasury stock for $24 per share and later sold the Treasury shares for $21 per share on March 1st. So the entry to journalize the purchase of the Treasury shares would include. So how would we determine? We see that there's 3,750 shares for $24 per share. It's asking us to journalize the purchase of the Treasury shares. So therefore, simply stated, 3,750 shares were purchased for $24 per share. So based on this information, the journal entry would be a debit to Treasury stock for $90,000, the 3,750 shares that we purchased for $24 per share. We would debit our Treasury stock and we would credit cash because cash is being paid for the stock. Next, we have, as a result of these two transactions combined, it says Treasury stock that was purchased for $3,000 is sold for $3,500 as a result of these two transactions. All right, so we purchased, and think of it even in a logical way. You purchased something for $3,000 and you sold it for $500. That's an increase to your equity. So therefore, stockholders' equity will be increased by $500. Next, we see the entry to journalize the reissuance would include a credit. Treasury stock that had been purchased for $5,600 last month was reissued this month for $8,500. The entry to journalize the reissuance would include a credit of. So we see that there's a difference between the two. We purchased it for $5,600. It was resold for $8,500. So $8,500 minus $5,600. There's a difference of $2,900. So based on that, we're going to either choose C or D. So for this problem, when we record the journal entry, we would debit cash for $8,500. That's how much we're receiving. We would credit Treasury stock for $5,600. And the difference would be paid in capital from the sale of Treasury stock for $2,900. Next, we see Nevada Corporation has 30,000 shares of $25 par stock outstanding that has a current market value of $120. If the corporation issues a 5-for-1 stock split, the number of shares outstanding will be. So based on this information, the sales, wrong problem. All right, so based on this information, the current shares outstanding are 30,000. And the ratio of the stock split is 5. So therefore, the shares outstanding after the stock split is 30,000 multiplied by 5. So therefore, 30,000 multiplied by 5. The total shares outstanding would be $150,000. All right, next is asking us to journalize the entries for April 1st and April 7th. On April 10th, 10,000 shares of $5 par common stock were issued at $22 per share. So we'll get our calculator. 10,000 shares were issued for $22 per share. They received cash of $220,000. And we know that our common stock is valued at $5 per share. So 10,000 multiplied by $5, which is 50,000. And the difference between the two would be our paid in capital in excess of par. So 50,000 represents the value of common stock, but we received 220,000. So the difference between the two is 170,000. Next, for April 7th, we have 5,000 shares of $50 par preferred stock issued at 104. So 5,000 shares sold at 104. We received cash of 520,000. The value of our preferred stock, as the problem lets us know, is $50 par preferred stock. So 5,000 shares times $50. The value of the preferred stock is 250,000. And then the difference, which is our paid in capital in excess of par preferred stock, is the cash received of 520,000 minus the value of the preferred stock, which is 250,000. So the difference of the 270,000 represents our credited amount. Here it states on May 10th, company issued for cash 1,500 shares of no par common stock. So essentially, we're doing the same thing. We know we're receiving cash, 1,500 shares for $14 per share for a total of 21,000. I'm just going to make this a little bigger so we can see our calculator. All right, so 21,000. And the value of the shares, the stated value of $2, so 1,500 times 2. So our common stock has a value of 3,000. And the difference between the two, the cash received of 21,000 minus the 3,000, which represents the value of our common stock, that represents our paid in capital in excess of stated value. Common stock for the difference of 18,000. And then next it says on May 15th, we issued for cash 2,000 shares of $15 par preferred stock at $58. So 2,000 shares at $58 each. We received cash of 116,000. Those 2,000 shares are valued at $15 per share. So we would credit our preferred stock for 30,000. And the difference between the cash received of 116,000 minus the 30,000 is $86,000, and this represents the paid in capital in excess of par preferred stock. So this brings us to our next question, and here it asks us to determine the dividends per share for preferred and common stock for each year. All right, so some key things to keep in mind that when we are dealing with stock, we have what's called preferred and we have what's called common stock. So preferred stock dividends are paid before common stock dividends are paid. Preferred stock dividends are typically a fixed percentage of the par value, and common stock dividends are calculated after paying the preferred dividends, and then the remaining dividends are divided among the common shares. So based on this information, the problem lets us know that for year one, 50,000 shares were distributed, year two, 90,000, and then year three, $130,000. All right, so as we pointed out with the preferred shareholders, they are guaranteed to receive a certain amount of dividends each year. So we need to factor that in. So it says that they have 40,000 shares of $100 1% preferred stock. It's a little bigger. Okay, so in order to determine how much is going to be paid for our preferred dividend, it's the total preferred shares of 40,000. Now I should do this calculation somewhere else so we know how much needs to be paid. All right. So it's the 40,000 shares multiplied by $100 per share. That gives us 4 million. And what the problem lets us know is that 4 million represents the total value of the preferred stock. And we are guaranteed to receive 1%. So what that simply means is that each year, preferred shareholders, they must be paid 40,000. And this lets us know, in this case, that they have to receive each year $40,000, right? Because they have what's called cumulative preferred shares. So let's say 1 year they don't have enough to pay the shareholders, then in the future year, they basically have to make sure that they catch up on what they owe to preferred shareholders before they can pay the common shareholders. So this is how we calculated the 40,000, the total preferred shares multiplied by the par value, multiplied by the percentage. So that is how we got the 4 million. 40,000 multiplied by 100, that represents the preferred stock, multiplied by the 1%, which represents the dividends that we are promising to pay the preferred dividend shareholders each year. So based on this information, we're promising each year to pay 40,000 to our preferred shareholders. And again, if there's a year where there is not enough, it will be carried forward and they would have to pay it in the following year. So the amount of dividends distributed in year one was 50,000. And the amount, again, that we had to pay to our preferred dividend shareholders were 40,000. So therefore, 40,000 went to the preferred dividend shareholders, 10,000 went to the common shareholders. So in order to determine the dividends per share, it is the preferred dividends distributed, which is 40,000, divided by the number of shares outstanding, which is 40,000. So $1 represents our dividend per share. We do the same thing for common stock. So the common stock shareholders receive 10,000 shares and there's 1,000 shares outstanding. So therefore, it's 10 cents per share. All right, let me just make this a little bigger. All right, 10 cents per share. So we move on to year two. So for year two, $90,000 worth of dividends were distributed. $40,000, as mentioned, is always going to go to our preferred shareholders in this case. So the difference that was paid to our common shareholders was $50,000. So to determine the dividends per share, the amount of shares distributed to our preferred shareholders was 40,000. The amount of shares outstanding, 40,000. So the value was $1. For our common stock, we received 50,000 shares divided by $100,000, 100,000 shares outstanding rather. The dividends per share in year 2 is 50 cents. In year 3, we distributed $130,000 worth of dividends, and 40,000 went to our preferred shareholders. The rest went to our common shareholders. So our preferred stock is 40,000 dividends distributed divided by the 40,000 shares outstanding versus our common shareholders. 90,000 shares were distributed and there was 100,000 shares outstanding for 90 cents. All right. So the key thing to keep in mind is that for the preferred dividends, we need to determine the amount that we are guaranteeing to pay. So it's 40,000 multiplied by 100 multiplied by 1%, and that lets us know that we have to pay our preferred shareholders $40,000 minimum each year. And the difference is going to be distributed to the common shareholders. And in order to determine the dividends per share, it is the dividends distributed divided by the stock outstanding. So in the first example for year 1, we paid $40,000 to our preferred shareholders. There's 40,000 shares outstanding. So 40,000 divided by 40,000 is $1 per share. And for our common shareholders, 10,000 shares were issued divided by the 100,000 shares outstanding. It was 10 cents per share. All right, so this brings us to our last problem. Here it asks us on April 2nd, a corporation purchased for cash 5,000 shares of its own $10 par common stock at $16 per share. It sold $3,000 of the Treasury shares at $19 per share on June 10th. The remaining shares were sold on November 10th. So it's asking us to record these journal entries. So for A, 5,000 shares were purchased at $16. So we know that we're receiving cash, and our journal entry is going to be as follows. We debit cash, $5,000 times 16. We receive cash of 80,000. Or sorry, we pay rather. So we're going to be debiting our treasury stock for 80,000, and we're going to be paying cash of 80,000. So we credit our cash account for the 80,000. Next, it says that we sold 3,000 of the shares at $19. So in such case, 3,000 at 19 equals 57,000. So therefore, we received cash of $57,000, and the treasury stock, the value of the treasury stock would be the 3,000 shares multiplied by the $16 per share. So our treasury stock is valued at $48,000, and the difference between the two, the value of the stock, $48,000 by the cash received, the $9,000 represents the paid in capital from sale of treasury stock. And now the last part of the entry says that the remaining 2,000 shares were sold for $12 per share. So 2,000 shares times $12, we received cash of 24,000. The treasury stock value at the treasury stock value is 32,000, right? And how do we determine that? We paid $16 for each. So 16,000 or 32, yeah, correct, 32,000. So therefore, the difference between the two, the paid in capital from sale of treasury stock, we have a loss in this case for the difference of 8,000. So therefore, in the scenario on June 10th, we had a gain. And then the scenario on November 10th, we had a loss. All right. So this brings us to the end of the review for exam 1, which covers questions from chapters 10, current liabilities, chapter 11, bonds payable, and chapter 12, stock